Adjusting journal entries. There are two bases for recording expenses and revenue: cash basis and the accrual basis. The cash basis records revenue when cash is received and records expenses when cash is paid, whereas accrual basis records revenue when it has been earned and records expenses when they are incurred. Adjusting entries are made only when: number 1, the accounting period is finished; number 2, a trial balance is completed. Once journal entries are made and posted in appropriate T accounts, we are ready to make an adjusted trial balance. 4 scenarios of which include: deferred revenue, when a company receives cash before it provides a service; receiving the cash before providing the service. An example: airlines receive our money before we fly; receiving our money before we actually fly. Deferred expense, when a business pays for a resource before it consumes it, paying for a resource and then consuming it. An example: when you pay for rent a period in advance before you occupy the house, paying for rent, then occupying the house. Accrued revenue, when a company earns a revenue before it receives cash. Earning the revenue is first and then receiving the cash. An example of this: a painter who had painted a house but is yet to receive cash, painted a house, yet to receive the cash from doing this service. Accrued expense, when a company incurs an expense and pays for it later. Buy now, pay later policy. An example: employers pay employees once they have completed the task or job. Completed the task, then receiving their wages. Adjusting journal entry demonstration. A deferred revenue example: a company sells 12-month subscriptions to its magazines. On October 1st, the company receives $1,200 for 20 subscriptions. To record, the following journal entry would be made. On 1st October, debit cash $1,200, credit unearned subscription revenue $1,200. This would mean that assets increased by $1,200 and liabilities increased by $1,200. Relevant T accounts would be as follows: debit cash $1,200, credit unearned subscription revenue $1,200, and credit subscription revenue 0 because we haven't received anything yet. Financial statement at the end of each month. As of 31st October, company provided 1 month, meaning $100 per month. The following journal entry is made. 31st October, debit unearned subscription revenue $100, credit subscription revenue $100, meaning liabilities decrease by $100 and equity increases by $100. Relevant T account: cash, debit $1,200, unearned subscription revenue, debit $1,200, credit $100, total $1,100, subscription revenue, credit $100. Thank you.